Right, this week we're reviewing the Momentum Equity Fund. The size is 2.6 billion rand and it was established in 1987. Cobie, take us through.
Yes, one of those long-standing equity funds again. I mean, we've had a couple of those on the show. The manager there is Johan de Kock at the moment. There's a whole bunch of great managers that have been associated with this. Remember, the previous name for this was the RMB Equity Fund, and it's basically just changed its name now to Momentum Equity. We're going to be looking at performance numbers up to the end of August 2011. The all-share index again, the total return index there is the benchmark. Total expense ratio there of 1.44. Let's just look again at what performance numbers look like over time. And you'll be used to the way in which we look at these. The blue shaded areas, which is any of the areas that you see kind of through the screen over there, is the fund's return relative to its benchmark. So when it's below the line, or below the horizontal line, like over there, it shows underperformance. When anything is above the line, such as that over there, it shows outperformance relative to its benchmark. And then if you want to actually see what the benchmark has done on a rolling 12-month basis, you have a look at the red line. And you can see how that return looks over time. And you can see there's quite pronounced underperformance for this fund during 2007. That period that you see over there, as a crisis hits, you see some outperformance for the fund, very, very small, and then we continue to see some underperformance. Just to give you kind of some numbers, and just put them into period-specific times for you. 12 months, 15.9 versus 16.9, 24 months, 12.4 versus 14.2, and then over 5 years, 7.8 versus 10.1. So some underperformance certainly from this fund.
Right, well, given the fact that we've been talking about the cost of active fund management, we're looking at a total expense ratio, as you mentioned, could be of 1.44%. Roland, are you happy with this number? And how does we didn't actually talk about how we come up with a specific number when it comes to cost?
Well, I think costs are sort of you can't stick out too much and you can't charge nothing. So you tend to find costs cluster a lot. So fund managers will see what other fund managers are charging, but in the end, the investor has to decide whether they are getting the returns they expecting for the fees that they pay.
Are you happy with this 1.44%?
Well, given the performance over the recent period, maybe not, because we have seen some underperformance, so you're paying for not getting as good a return as the market. And again, is the market here, if the fund manager held cash or had a conservative bias, then again we can argue whether this all-share index is a relevant benchmark.
Exactly, and we said a little earlier, if you are going to use the all-share index as a benchmark, then you're actively deciding to choose that it's going to be a resource-weighted benchmark.
Resources did very well.
Exactly, and this is more of an industrial
Exactly. Most fund managers have a much higher industrial weighting than
I mean, top holdings, we've got MTN, Standard Bank, Sasol, Bidvest. We've got some BHP, of course, Old Mutual, RMB holdings.
You're going through the kind of the 06 and 07 kind of period and running up to 2008 when we saw Anglos and Billiton up at like a 22 PE. I know that the RMB team at that stage was quite negative about resources, and rightly so, because they said it was just very, very expensive. And as a matter of fact, it wasn't just them, it was right across the industry. A lot of active fund managers said, listen, please don't buy resources at these levels. You know, I mean, you're going to get a hiding to nothing as far as that's concerned. And interesting enough, I saw a lot of private investors at that point switch over and actually just go and track an index because the indices were just doing so much better. So you're seeing that fund, this fund now being an example of that, trying to claw back some of those returns. And we're sitting in a very volatile period at the moment as far as returns are concerned. Again, if you're going to be associated with this fund, make sure that you understand what Johan de Kock's trying to achieve. How is he trying to achieve it, and are you buying into that?
A huge financial holding, in fact, 30%. So that is quite high.
It's actually been tracking up. The exposure to financials is currently at an all-time high for this fund. So very much a bet on financials, which I don't think is a bad thing because financials are cheap now. This is the time you want to start ramping up your exposure over time. But remember that the exposure is not the same as the weighting, and we have seen a higher gearing to these financial stocks.
I mean, that's why you're going active. You want somebody to make a call. You want somebody to sit down and say, I've looked at these companies, I understand the fundamentals, and this is what I think the returns can be.
Well, we only want someone to make a call if they're making the right call, isn't that so, Cobie?
Well, you know, Eleni, in a perfect world, you know.
Absolutely. Also, just looking over the 1 year, you're saying that it has been underperforming. The fund has given a 20% return, the benchmark 23%, over 3 years a 4% return, benchmark 3.6%. So only slight underperformance that we've seen, say, over the 3-year period. Do you suspect, Roland, that this could turn around significantly? Well, because again, it's a bet on financials.
One of the other things I like about this fund and some of the analysis that we've looked at is that it does have a high industrial weight, but the exposure to industrials is actually quite low. And the way that works is if you're buying industrial shares that are conservative, in other words, that aren't geared, you can get this kind of effect coming through. So it's a conservative industrial exposure rather than an aggressive one, despite the high weighting. And I don't think that's a bad thing in these times.
Okay, Cobie, let's wrap things up. Your sense, the portfolio, would you be allocating money to this portfolio? You're buying into Johan de Kock's vision?
Well, I mean, firstly, again, like I said previously, the manager's trying to achieve something very specific here. You know, you look at the financial weighting, you look at how he's trying to position the fund. If you believe in that, and you believe that that's going to achieve returns long term, and you're prepared to pay the 1.44% for the fee that you're getting at the end, you know, for the fee for the benefit of this, then it's the right decision. If not, well, go find something else.